Aotearoa, and welcome to Monday's Economy Watch, where we follow the economic events and trends that affect New Zealand. I'm David Chaston, and this is the international edition from interest.co.nz, and today we lead with news. Things are turning sour in the trenches of the US economy, for consumers, for many non-prime corporate borrowers, and even investors in some local manufacturing they did at the behest of Trump. But first, in the week ahead, our news will be dominated by the March quarter CPI release on Wednesday for New Zealand. Japan, India and the UK will also release inflation updates this week. The central banks of Canada, the ECB, of Turkey, of Korea will be reassessing their monetary policy settings, and obviously they will be focused on how the global tariff war by the US will affect them, and the role monetary policy can play to mitigate the coming negative influences. China will report its first quarter 2025 GDP result, and Germany will report any changes in economic sentiment. On Wall Street, the first quarter 2025 earnings season will kick off, and reports from the major financial institutions will come in early. There will be a lot of attention on them, especially if they start to report a bumpy ride from economic uncertainty. However, the big news over the weekend is that China is standing its ground. Beijing raised its tariffs on American imports to 125% on Friday, heading back against Trump's decision to hike duties on Chinese goods to a total of 145%, and raising the stakes in the trade war. They repeated the fight to the end rhetoric, also saying they'll counterattack. They said, quote, "Even if the US continues to impose higher tariffs, it will no longer make economic sense and will become a joke in the history of world economy. At the current tariff level, there is no market acceptance for US goods exported to China," unquote. One immediate consequence of all this is that investors are turning away from the US dollar as a safe haven, and perhaps turning away from US Treasuries too. Equity markets seem to be ignoring a sharp change in US consumer sentiment. The University of Michigan survey plunged in April to its lowest level since June 2022, and well below what was anticipated. That's the fourth straight month of pullback, and this survey is now more than 30% lower since the November 2024 election. It is signalling growing worries about trade war developments that have oscillated over the course of the year. American consumers report multiple warning signs that raise the risk of recession. Expectations for business conditions, personal finances, incomes, inflation, and labour markets all continue to deteriorate this month. The gauge for current economic conditions fell along with the component measuring expectations, which is now at its lowest since May 1980. Meanwhile, year-ahead inflation expectations surged to 6.7%, the highest reading since 1981, from 5% in March. The 5-year inflation expectations gauge edged up to 4.4% from 4.1%. To mitigate some of that, Trump cancelled his tariffs as they affect mobile phones, their components, computers, and other electronics. Even for Trump, this is pretty odd. It is now very much cheaper to import iPhones and the like from China than make them in the US. There will be many investors, especially those who have started building out US manufacturing facilities at the behest of Trump, who are likely to be a touch unhappy with this flip-flop, and they still have to pay 145% tariffs on their imported parts. Clearly, Trump has no idea about how tariffs work, although that is not news. Meanwhile, Commerce Secretary Lutnick added confusion in a weekend interview, saying the tech tariff cancellation will be temporary. Meanwhile, March producer price inflation in the US actually eased to 2.7%, its lowest in 5 months, aided by a sharp drop in energy prices. Without those fuel cost savings, the index would have risen slightly to 3.3%. There are signs that lending activity is tightening sharply in the US. For 2 weeks, there have been no, that is zero, high-yield leverage loans for corporates. The funds making these loans are having sharp investor outflows, and banks have become quite risk-averse and are not stepping in. A credit crunch is underway for most non-prime borrowers. If it extends, there will be real trouble. In Canada, not only are they rejecting American products and travel options now, a new trend is that they are net sellers of US real estate they had as holiday homes. India released February industrial production data over the weekend, and that showed growth decelerated sharply to 2.9% from a year ago, down from an upwardly revised 5.2% in January. Markets had expected a 4% rise in February, so this is a big miss and is the weakest expansion since August. In China, their March new yuan loans came in at 3.6 trillion, sharply higher than the 1 trillion yuan in the February, and slightly more than anticipated. New bank debt support is flowing as they intend, but to be fair, it isn't overly different to the usual seasonal pattern. It is even less than the record March new debt flows in March 2023 of 3.89 trillion yuan, but it is the second highest March level ever and a 17.8% higher than March 2024. Meanwhile, foreign currency lending dived 34% though. China's vehicle sales jumped in March from February to 2.9 million units, but the near-term change is distorted by the Chinese New Year holiday period. NEV rose to 1.2 million of those units, now 42% of all sales. They seem to be on target to sell almost 33 million vehicles in 2025, almost double the level of the US. Meanwhile, state-linked Chinese funds, the Home Team, stepped in to rescue Chinese stocks last week. But it is an expensive exercise involving more than 7 trillion yuan so far, and likely to have to go up much more than that. China's own credit crunch is coming in at some point, but they can put that off for a while yet, it seems. Separately, China is also battling unusually cold weather at present, with much travel in the north cancelled. In Europe, German CPI inflation came in at 2.2% in March, slightly lower than in February and lower than expected. Food prices are up 3% though, and the price of services were up 3.5%. It is also falling energy costs that are keeping a lid on their inflation. Coal and steel prices are now falling, with the coal price now down to a level first achieved in 2016. The US Treasury 10-year yield is now at 4.50% and up 1 basis point from this time Saturday. The price of gold will start today at just on $3,236 an ounce and up another $2 from Saturday, and yet another new record high. That is up $217 or 7.1% from this time last week. And oil prices are unchanged from Saturday to be holding at $61.50 a barrel in the US, while the international Brent price is now just over $64.50 a barrel. These are the same levels we had a week ago. And the Kiwi dollar is now at 58.3 US cents, up 10 basis points from Saturday at this time and the highest since mid-December. A week ago it was 55.6 US cents, so a mammoth 270 basis points appreciation, or 4.7% since then. Against the Aussie, we're up 20 basis points at 92.8 Australian cents. Against the euro, we're down 10 basis points from Saturday at just on 51.3 euro cents. That all means our trade-weighted index starts today at just over 66.9 and up marginally from Saturday, up 130 basis points from a week ago. And the Bitcoin price starts today at $84,792 and firming, and up 1.2% from this time Saturday. Volatility over the past 24 hours has been modest at plus or minus 1.3%. You can find links to the articles mentioned today in our show notes, and you can get more news affecting the economy in New Zealand from interest.co.nz. Kia ora, I'm David Chaston, and we'll do this again tomorrow.